Hi everyone. Today it's time for my first controversial topic, Lending Club. A lot of people don't like Lending Club. I've been a fan of them for a few years and I've been investing with them for that same amount of time. I'm going to talk about what exactly Lending Club is, where I think it fits into your portfolio, what the performance data says, and what the loan risk and length of term mean to you, my experience with returns with Lending Club, the little secret of Lending Club, and then I will summarize it all up in the end. And as always, I'll talk about a little bit of jelly, which is something I enjoyed outside the markets. If you have big dreams like buying the McLaren Elva, or if you're just getting started on your financial journey, definitely like and subscribe. As you can see, it does not have a windshield and it will cost $1.4 million. To keep your dreams at the front of your mind, like and subscribe. Welcome to the Portfolio Bulletin. Let's get started. So what is Lending Club exactly? Lending Club is a peer-to-peer lending platform which links up investors like myself to borrowers. So you can diversify your portfolio based on risk. They have been around for more than 10 years, and these are loans, so they pay out monthly like any other type of loan. Before we go further, let's talk a little bit about what I think Lending Club is and what its role is in your portfolio. So Lending Club is essentially individual bonds that you are lending in $25 increments. You lend this amount of money to that person. They pay you interest on that bond, and then over time, they pay back the principal of that bond. So a way to think about this is individual bonds. It's not going to appreciate the same way an equity can, but it's also not going to go down in value the way that a corporate bond can. And there are credit repercussions for the borrower if they default on these loans. So now we know how it fits into our portfolio, so let's see exactly how it works. So a borrower takes one loan. Those loans are broken up into multiple loans for the lender, and that allows you to diversify across multiple loans. So they have loans from A to D rank, A being the safest and D being the most risky. The interest rates correspond to that as well. So A is going to have the lowest interest loans and D is going to have the highest interest. They offer 3 or 5 year terms, and you can invest with $25 increments. This is generally what they expect. So your average interest loan is going to be 14%. They expect an 8% loss, and then Lending Club takes a 1% cut, averaging somewhere around 5%. But I'm going to show you how this is on the low end of returns if you do it properly. Also, they offer a few different types of accounts. They do have IRAs and individual taxable accounts. They do have some joint accounts and trusts if that's something you're interested. I don't have any of these. However, I do have a retirement account and an individual account with Lending Club. So let's talk about returns. This chart is basically showing how the number of loans that you are invested in directly corresponds to your returns. So they show less than 40 loans, which is $1,000. They expect somewhere between a negative 10% and a positive 13%. If you go over to 40 to 99 loans, they expect somewhere between a 1.5% return up to a 7.7% return. And then the further you go out in number of loans, they expect you'll be closer to a 5% average. Going over to grade of loan, like I mentioned, A is going to have the lowest returns because it has the lowest interest rates. B, a little bit more risk, but a little bit more return on average. C has, again, a little bit more risk and a little bit more return. And then as you get out to D, there's quite a bit of risk here. So this chart that they have here shows the wide range. So you could be anywhere down from 3.39% up to a 9.34% return on D note loans. And then across the different loans, they expect somewhere between a 4 and an 8% total return. And then this chart shows the correlation between the length of the term and the total returns. So a 60-month loan is going to have lower payments. And this is a little bit of my theory here. Because the 60-month loan has lower payments, it's easier for the borrower to make those payments. And you can see here the midpoint for 60-month loans is 6.86%, where the midpoint for 36-month loans is 5.37%. So it really does pay to have longer-term loans. This page correlates the amount of notes owned to the positive rate of return. So if you see here, less than 100 notes, about 20% of people see a negative adjusted return. But if you have more than 100 notes, you will see a positive net adjusted return, which is the NAR up here. This is why I suggest you start with at least $2,500 if you plan on investing with Lending Club. So now that we know what Lending Club is, let's talk about what my experience with them has been. So here you can see my annualized return. It's about a 7.7%. This is my current account value, available cash, and then the amount of interest I've received over the time of this account being open. It's about $3,126. If you click on notes at a glance, it'll show you exactly how many notes are overdue, how many are in default, and how many notes have been charged off. Charged off means they're no longer being tracked by Lending Club and they have been sent to a third-party debt collector, and you rarely receive any money from those. And if you do, it's a very small amount. If you move on to payments, it'll show how much you've received in principal, interest, and then late fees. And then this is how much they're currently removing for past due notes. It's about $408. And then this shows, again, your current account value. This is the account value before they remove the amount they estimate for notes past due. So here's my current portfolio breakdown. I have 3.9% in A loans. I have 35.6% in D loans, which is higher than I would like. And I'm currently not putting any more money into D loans. B loans, 15.5%. And then C loans, 42.9%. So C loans is definitely my highest category and has the highest returns without going into too much risk. And then if you click here and go to term, I am 77.1% in 60-month loans, and that's where I want to be. 60-month loans have consistently given me the best returns, and the only reason that I have 36-month loans at all is because there aren't always 60-month loans to invest in, and any cash that you're sitting on is going to reduce your returns more than investing in a 36-month loan versus a 60-month loan. So cash sitting on the side generates no interest, and I always want my money to be generating interest. So I consistently reinvest all of my money with this platform. My average weighted return up here is 16.74%. This is unpaid interest currently accrued, $173. Payments to date, this is since the account was opened, and that includes principal and interest. So I've received $11,225 in payments, and then it breaks those down into principal and interest here, and then late fees. Here you can see they break down your total account value. Available cash is money less than $25 for me because you can't invest in a note with less than $25. Committed cash is money I have put towards loans that have not received their full funding, and I'll explain that a little bit more later. And then outstanding principal, and then the amount reduced for past due loans, which I already mentioned. Here you can see how much I have paid in fees. Recoveries is what I talked about for charged off loans. I've received only $77 over the course of this entire account being open, which is not a significant amount of money considering how many notes I've had go into default. And then this is how much money I have committed to different loans, $27,000. And I'll explain why this number is so large relative to my account value later. Here we have the activity log. If you click here, you can see what payments were made this day. You can see it's separated into principal and interest payments. You pay 1 cent in service fees per payment. None of these notes were late, so I didn't pay any collection fees, and I also didn't receive any late fees. Here you can see the low number is around 56 cents and the high number is around $1. So I will use 75 cents in my example. Here's what the investment page looks like. I always sort by FICO score first. So I get the highest FICO scores at the top, and then I look based on the term. So right here we have a 60-month term, a C note, 17.3%, $15,000, and a FICO score between 720 and 724. You can scroll down and see this is what their monthly payment would be. This is how long they've been employed at their job, their reported income, and what they do for a living, where they're located, debt to income ratio, and revolving credit balance, which is credit card balances. And you can see if they've had any delinquencies in the recent past. Also, their revolving credit utilization is here. So when I'm looking at a loan, I want to see that this payment is pretty low. I want to see that they've had a few years of employment. If they rent, that's okay. I prefer a mortgage. It just seems a little bit more stable to me. But the biggest thing here is a borrower can borrow up to $40,000, and a $15,000 borrower seems a little bit more reliable to me than someone who's trying to borrow that maximum amount of money. It seems like a person who is borrowing just what they need and not going to borrow as much as they possibly can. So from previous data, I like to see a lower borrowed amount, a 60-month term if possible, which reduces that payment as I already talked about. a lower debt to income ratio if possible, somewhere between 25 and 30. I prefer mortgage, but in a C note, this is okay. A good FICO score, 720 to 724 is good. They've had no delinquencies and an okay revolving credit balance, which makes sense. If they're trying to refinance this credit balance and they're borrowing $15,000 and their revolving credit balance is $15,008, then this loan makes sense to me. And if I had uninvested money, I would choose this loan. Here's a B loan. See, it's a 36-month loan and it's a high balance. So it's a $38,000 requested amount and they're trying to pay this off in 36 months. So they're going to pay $1,303 every single month. That's a lot of money to pay every single month. So a loan like this would be a little bit off-putting to me. It says here that this person makes $37,500. That sounds a little questionable to me. It's a little bit high. And one thing to note here, if it doesn't say that the income was verified, then they can essentially fill this number in. Scrolling down, if this person makes $37,500, why are they trying to borrow $38,000? That just doesn't pass the mental test to me. Also, they have a delinquency in the last 2 years, and it's only been 7 months since their last delinquency, a revolving credit balance of $26,000, and they're trying to borrow $38,000. So this loan does not seem like a good investment to me. Moving into an A loan, this one's a little bit more reasonable. It's only $23,000 on a 36-month loan is okay. A more reasonable monthly income here at $8,800. Again, no delinquencies is what you want to see, and a low revolving credit balance. It's a little strange that they're trying to borrow $23,000 when it says their revolving credit balance is only $6,600. But they do have an extremely high FICO score at 805 to 809. So I would probably invest in this loan if I was looking for an A loan at this time. And one more example here. We have a 60-month loan, which is what you want to see. $30,000 is a little bit on the high end. It's closer to that $40,000 upper limit. But here they have a joint income. So this person is married. They own their home and they have been employed for more than 10 years. So those are all things that you want to see. Joint debt to income ratio is right at 22%, which is nice and low. Months since last delinquency, 52 months. So that was several years ago. And then revolving credit balance, $2,300, which seems a little bit low compared to the $30,000 that they're trying to borrow. Maybe they're just trying to make sure they have a little extra to pay off what they have. But overall, looks like a pretty safe loan since all of this information here looks really good. So I would also invest in this loan. Just to cover the committed cash portion that I talked about, this loan is $6,000. It's currently 61% funded, which means $2,325 still need to be committed to this loan. So if you have committed cash, that means you've committed money to this fund, but the total amount of the loan hasn't been collected yet, so it can't be processed and distributed, which means you can't collect payments. So this loan has 29 days to see if it receives its full funding. Once it's received its full funding, then the loan will be distributed to the borrower. So here's the power of Lending Club. Here you have notes. The amount of payment, which I said before, was going to be about 75 cents per month per note. Principal, I split it evenly half and half between principal and interest. And the notes here, there's 100 notes, which is the $2,500, which is the point at which it's unlikely that you will lose money. So if you sum up all the payments, you get $75, which is the 75 cents times 100 notes. And then your starting account value is the $2,500, which is 25 times 100 notes. And then at the end of the month, your finishing account value would be $2,537.50, which is the interest payments. But the really cool thing here is at the end of this month, you would actually own 103 notes. So you're only investing an extra $37.50 to get 3 extra notes, which is $75 worth of notes. So because of this principle that I just demonstrated, that's why my investment value, if you remember, was $27,200 when my account value was actually $17,292. So this exponential growth from increasing the number of notes that you own versus the amount of actual capital value invested is what allows you to generate a higher return than that 5% that was originally shown. So here is what the monthly statements look like. They show you your account value, the net change. This is your account value without any losses. And then during this period, they show I was paid $257 in interest. I received 24 cents in late fees, and then $114.91 of loans were charged off, resulting in a net profit of $142.44. Over here, you can see my account value by month. So in May of 19, I really started prioritizing this investment platform to up the percentage of my overall portfolio. And since then, I have been adding periodically, but most of this has been interest growth without added investment. This month, you can see I only added $100. Here you can see the cash details. So funds invested, $850. Remember, 100 of that was deposits, but you can see I received almost $600 in principal paid back and $257 in interest. So usually when principal is this high, it means someone made some pretty large payments, or they potentially paid off their loan early or something to that effect. So I took all of this money and reinvested it. So I was able to reinvest $850 worth of notes this month. And then on the next page, they give you a breakdown by percentage. So you can see here, I've been increasing my A and B loans, and I've been trying to decrease my D loans since the end of the month. And then as you scroll down here, it just goes into each and every single loan that you own. So all the fully paids are at the top, and then as you go down, it'll show each and every loan that you have invested in. All right, so what are the takeaways? Number one, Lending Club is a peer-to-peer lending platform. They require a $1,000 minimum deposit, and you can invest in notes in $25 increments. I do suggest that you start with a minimum of $2,500 if you're interested in Lending Club. The notes you own are like bonds. However, they are generally illiquid. You cannot withdraw the money from a loan until that loan is completely paid off. You can withdraw the payments each month if you choose to do so. They do have a platform where you can sell the notes. I don't have any experience with that platform, and it's my understanding that if you try to sell notes there, they will be sold at a discount. So you are likely to take losses if you sell them there. On average, they expect a 5% return without compounding. However, after a few years, I'm currently sitting at a 7.68% return. And then last year's profits for me were $1,164. And then here's the big key takeaway. Compounding note ownership, which means you will own more notes than simply investing a set amount of money at the beginning. As time goes on, you will own more notes than the capital you invested with reinvestment, which allows you to collect more money than you would with just capital deposits. If you do choose to invest with Lending Club, there's a link in the description. And of course, this is all my opinion and my experience. This is for entertainment purposes. If you choose to invest in Lending Club, consult your financial advisor and your results may vary. And with that, let's get to the jelly. So Hafthor Bjornsson broke the deadlift record, which is pretty crazy. He lifted 501 kilograms, which is 1,104 pounds. It's the world deadlift record. And here's what that looked like.
Let's go for it. Come on.
I assume Thor feels about as accomplished here as I do finishing this video. This video really took a lot of time, a lot more time than I thought it was going to. So please like and subscribe if you like this kind of content. You definitely must like this kind of content if you made it this far. So thank you very much and have a great day.